Welcome warmly to my lecture on transaction exposure. There are three major forms of currency risk that a company with subsidiaries in a foreign country faces. That is, if you are working for a firm that does operations in Japan and your firm is a German firm, then your firm faces these risks or exposures. Number one is called transaction exposure. We also call this contractual exposure. Number two is called translation exposure. And the last major risk that a firm has when it deals in foreign currency is operating exposure or economic exposure to foreign exchange risk. In these lectures, which are based on Harvard Business School lecture notes, I will go over all these different uh, foreign exchange risks that a firm faces. Let's get started with transaction risk. What is transaction risk or transaction exposure? This risk refers to gains or losses. These words are important and should be marked in red. You can make money from this risk, and you could lose money because of this risk. In economic and finance, when we have a risk that can only lose you money or cause losses for your firm, we call it a hazard. For example, a fire is a fire hazard, and we purchase fire insurance for it by paying a premium. However, risk and uncertainty generally means that we can make gains or money and we can lose money. This point is very important because in most of our minds, risk is a negative word. Later on, we make this precise by saying we are risk averse. But risk being a negative word does not mean that risk will lose you money all the time. In fact, in finance, out of greed, we take risk, we shoulder risk because we want to make money off it. We go and venture in order to have a gain. Therefore, the gains that come from risks are also important for us, but there are losses. Back to this definition. Notice that we are taking these definitions like legal documents and we are pausing on every word. Every word is meaningful and carries a weight. And you don't want to waste words and have extra gibber jabberish words in a definition. Everything should be meaningful. So, this transaction risk refers to making money, gains, or losses that may be incurred when future monetary transactions. This word future is also meaningful. It means you have to pay 6 months from now. You have to pay a year from now. They would pay you foreign currency 2 months from now. So the payments actually take place in the future. If the payments took place today, current time, we have no risk because current exchange rate is known. Immediately we run to a bank and change our money to home currency, and we will get the fixed rate that is prevailing right now. The next two words talk about monetary transactions. So you buy something and you have to pay money for it, or you sell something and you receive money for it, or you invest and have to pay for this investment and finance it, or someone else invests in your firm. These monetary transactions that are, according to a contract, taking place in future are settled in a foreign currency. And of course, this word foreign currency is important. The foreign currency gives us the risk. the fact that we have to produce 100 million Japanese yen a year from now is risky. If it was our own currency, its value doesn't change. It would just be a cost that would go in our accounting ledger, even though we would incur it in the future. Let's look at a couple of major examples of transactions exposure. A company, perhaps the firm that you're working for, buys or sells on credit. And this word on credit means that they don't pay cash and carry. They're going to pay later but get the product now. A product that is priced in a foreign currency. Example number 2. Now we are in investment market. So a firm lends money or borrows money as capital, and this lending or borrowing is in units of a foreign currency. For example, a South American country borrows $1 million. Okay, let's work a very simple example to illustrate that in fact we have a risk or exposure that we have to worry about. Imagine that a British company, a car dealership, buys cars from a German firm. A Mercedes dealership in London is buying Mercedes from Daimler and taking them to the showroom. The total contract price written today is 1 million euros. 1 million euros wholesale worth of Mercedes are delivered to the showroom by the German firm. However, the dealer doesn't have the money. If you make it cash and carry, it would be hard to sell those cars. There is a term of trade, traditionally, customarily, with this dealer, it's 90 days. So the dealer has some time to sell some of these Mercedes in its showroom, make some money, get financing, and pay this 1 million euros to Daimler. This is an old Harvard Business School example. So the exchange rate is 2 euros per 1 British pound. Why am I doing an old case? First of all, for a classroom purpose, this 2 to 1 is very easy and pedagogically nice to work with. Second, as I mentioned before, this is a good lecture note that you could also purchase from Harvard Business School, and it's a classic, so a few years had passed. It also illustrates that, the value of British pound against euro fluctuates. It's getting closer to parity. British pound is getting cheaper, and every day this rate changes, and that's in the heart of our story. Okay, take a rate of 2 euros equals 1 British pound. So at that rate, the British company, at the time that it writes the contract, owes 1 million euros to the German firm. But 1 million euros makes 500,000 British pounds. In other words, 1 million euros divided by 2 euros divided by 1 British pound. Notice that I put the units, and this is an old engineering trick. If you put the units in, then you would have no mistake at the time of exam. The 2 euros here cancel each other, and the British pound way downstairs does a somersault. You know a somersault. You put your hands down and go over your head, and you come back the other way. So this unit British pound comes out and works out. If I'm hassled in an exam and instead of dividing I multiply, then I get euro times euro, euro a square. And once I tell you euro a square, you say, well, you're funny. Something is wrong with you. There are no euro squares. So I know that I have confused the units. Okay, so very simple example and makes the case. The dealer owes 500,000 British pounds for these cars. Now the dealer could sit down and figure out its markup, its cost of overhead, running this showroom, employees, and price the cars and make a decent or perhaps non-decent profit from this deal. Let's continue our example. Time passes, and 90 days from now, the exchange rate can do whatever it wants. And fluctuations of exchange rate in 90 days could be quite drastic. In this case, let's consider two scenarios. Scenario number one, euro becomes cheaper. So 2 euros and 5 cents buy a British pound. Under this scenario, the British firm owes still 1 million euros because that's written in the contract. Divide that 1 million euros by 2.05 euro per 1 British pound, and you get 487,805 British pounds. On purpose, I did this example so you see a gain from foreign exchange risk. The dealer just made more money because instead of paying 500,000 British pounds, it pays 500,000 minus 487,805. I shouldn't have said pays. It saves the difference. 487,805 British pound is what the dealer should pay under this scenario, and it saves 12,195 British pounds or extra profit. And this extra profit or gain is because of the transaction exposure, and the rest of dealers' profit or gains are, of course, uh, because of doing business. However, the dealer may not be so lucky. In 90 days, the exchange rate could do something else. Let's take scenario number two. Euro depreciates. British pound becomes stronger. In this example, a euro and 95 cents buys 1 British pound. Let's work out our simple example with these numbers. The dealer got to pay 1 million euros divided by 1.95 euro per 1 British pound gives us 512,821 British pounds. So the dealer pays 12,821 British pounds extra. 512,821 minus 500,000. The difference is a loss, a transaction exposure cost loss of 12,821. So these two examples together illustrate that movements in foreign currency could cause this dealer losses or gains. The dealer says, look, I'm very good at selling cars, but I'm not good at speculating foreign currency prices. That's not the core of my business. I want to stick with the core of my business. I want to get rid of this foreign exchange risk. Well, just like any risk, there is possible to purchase insurance against risk. We call that in finance hedging. So we are going to study ways to hedge or purchase insurance against this foreign exchange risk, which we call transaction risk or contractual risk. We call it contractual risk because it always involves a contract. Before we go forward, let us philosophically think about this problem a bit more. And that thinking is based on the following question. Nice little exam question that may get you confused, but here it's easy. The answer is right there in the slide in front of you. And that question is, what is the German firm's uh, exposure, and we mean transaction exposure, in this simple example that we worked out together? And the answer is that the German firm has no exposure. If we are more precise and we go to the definition says you have to transact in foreign currency. But the German firm wrote the contract in euro, which is their domestic currency. There is no transaction exposure. The German firm gets paid in euro, and all its costs are in euro. Then a simple-minded um, solution to foreign exchange exposure is insist that the contract is written in your home currency, but not so fast. The world of business is a bit more complicated. First of all, we may lose sales if we do that. Second, one firm may be better than the other, shouldering a risk or exposure. For example, if we happen to have income in a foreign currency and cost in that foreign currency wash out that income or use up that income, then we may take a foreign currency deal. Lastly, the business world is brutal. Maybe someone has more market power. For example, if we have a hot car model and everyone is lined up to purchase it, then we might be able to dictate that it's sold in our currency. And if these cars are very hard to sell, the dealer may have more market power. And of course, there are a host of other marketing issues, which are not really the core of our topic. But this question of why the German firm doesn't have exposure or what is its exposure philosophically makes us think about this, that there are two firms and one of them would carry the risk. And if we are the firm that we must carry the risk on our shoulder, the foreign currency risk, we must price this risk as a cost. And we should consider that cost and bring it up in negotiations. We should get a better deal because we are shouldering this cost. And we should be aware of it. That gets us to the next question, which again is a very nice and fun question in my exams. It says, should the British firm demand that the German firm somehow make up for its transaction exposure? And this somehow is loaded. It has this marketing and power, suppliers' power in mind. Yes, the answer is yes. Risk is costly to bear, costly to shoulder. After all, the German firm may write the sales contract for 500,000 British pounds. Now the German firm has all the risk because it gets British pounds. The British firm should consider the transaction risk exposure as a cost item in addition to the cost of the cars. Okay, so far we had a discussion that said, yeah, this deal can cause us perhaps 12,000 British pounds of losses or gains. It may be a drop in the bucket. Is 12,000 significant for us to go through a headache and listen to these lectures? Let's go back a little bit in history and justify ourselves, justify why we are studying this foreign exchange risk, why we look at ways to hedge it and buy insurance for it, and why is it so significant to our jobs, to our firms. To do that, we go back to another British firm called Beecham. And we go back to the year 1971. Beecham is dead and buried in the name of several conglomerates today because it went bankrupt. In 1971, the business environment in UK was not so good. The economy was not so good. Beecham was doing well, but needed financing, additional financing for expansion, borrowing financing. Um, this wasn't available easily from the British banks. So Beecham went to Switzerland. Well, Swiss secrecy laws, all those monies that were going to Swiss banks were available as capital internationally. And Beecham borrowed 100 million Swiss francs at a reasonable interest rate or cost of capital at that time. At that time, the exchange rate was 10 Swiss franc per 1 British pound. That meant that Beecham owed 10 million British pounds. 100 million Swiss franc divided by 10 Swiss franc per 1 British pound gives us 10 million British pounds. Let's continue this story just about 5 years later to 1976. This 100 million borrowing in 1971 in Swiss francs had become 22.7 million British pounds because in 1976 the exchange rate Swiss franc appreciated from 10 per 1 British pound to 4.4 per 1 British pound, more than doubled in value. And of course, Swiss franc had continued its increase in value, and nowadays it's getting close to parity um, with British pound. Got close to exceeded in value from dollar and got close to parity with euros. So this is an ongoing story with Switzerland, but a different story from the one we are considering here. So Beecham borrows 100 million Swiss franc, expects to pay 10 million British pounds, and suddenly the loan had more than doubled to 22.7 million British pounds. And the magnitude of this payment, a bullet loan that was required for servicing this debt, a bullet loan means you have to pay all of it in one payment at the end, was large enough to bankrupt this firm. Suddenly, the chief financial executives, finance people, international finance people woke up. If there is a risk that can make us go bankrupt, make us lose our jobs because our firm is bankrupt, then this risk is just like that fire hazard, something that is worthwhile to hedge or buy insurance against. It's definitely significant. It's not a drop in the bucket. As a sideline to this story, notice that before 1970s, in a period after Second World War, foreign currency values were fixed against each other. There was a meeting in New Hampshire, and British pound, um, 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 Japanese yen, and German mark, Deutsche Mark, they were all fixed against US dollar, and US dollar was fixed against gold. I believe the going rate was about 1 ounce of gold being something like $37. That also talks about the inflation that we had all these years. Um, about 32 ounces is a kilo, and 1 ounce of gold is something like $2,000, if I'm not mistaken, these days. From 37, we have gone to 2000. Anyways, going back to this old time, in 1970s, in a window of time between 70 to 76, and this fixed foreign currency regime collapsed. Um, the Americans had this gold, and they would promise that if you give us 37 US dollars, we would give you an ounce of gold. So dollar was backed by gold, and the gold was literally there in some military barracks. And in early 1970s, the British called the American bluff. The gold wasn't there anymore. There was too many dollars in circulation. And in a window of time, we came off this fixed exchange rate backed by gold, and we got an exchange rate which which fluctuates. And very quickly, the value of certain currencies, such as Deutsche Mark, Japanese yen, and Swiss franc, increased against dollar. So the moral of this long story is that Beecham was not should not be faulted so much for this deal. It wasn't expecting the foreign exchange values to fluctuate and become so cheap. And of course, later on, we had a similar deal with South American debt crisis. Again, most of this debt was in dollars, and the home currency of these countries against dollar depreciated quite a bit and made some countries bankrupt.